Investors taking profits Monday as the main indexes retreat from their record highs. Well, let's get some tips on managing risks and investing in the credit markets. We're joined from Dallas, Texas by Mark Okada. He is CEO of Sycamore Capital Partners. And good afternoon and welcome, Mark.
Hello, Fred. Good to see you. How are you?
Good to have you with us, Mark. Doing fine. Now, Washington, basically was shrugged off by Wall Street last week amid the Capitol riots, and Wall Street just went on to record highs. Now that the Democrats have actually begun their push to oust Trump, what risks do political actions in Washington pose for investors on Wall Street?
Your question about being a risk manager, I think, is the right one. Because that's really what we do, right? I mean, everyone that's in a seat like mine is advising some capital. And if you have a risk lens, I think that's the right lens as opposed to an opportunity lens. And so when we think about what's happening across that, some of these market moves don't make a whole lot of sense unless you think that maybe there's been some sort of policy mismatch across markets. I'm in that viewpoint that this was a health crisis and not a financial crisis. The Fed and fiscal policy response has been more to a financial crisis. And so we've seen markets zoom back to places that are really kind of not understandable. And now we're facing a time where there's kind of a reckoning of that situation. And there's good news and bad news, and I think a lot of this movement in the market has created some awareness of the risks that we're all trying to handicap.
And Mark, the market's not far from record territory. The S&P technically is in overbought territory. Do you sense that we're on the cusp of a correction, or is it still onwards and upwards? New administration and vaccine rollouts, and all's fine from here?
Well, I think we have to kind of have different views on the economy versus markets. We've only seen two times when we've had a 60+% bounce. That was 82 in 2009, and then this last period to today. And the next 9 months after that, we're not so good. So I think looking forward from here, yeah, we've got the blue wave. Yeah, we'll have some pretty big stimulus, but we're going to face higher interest rates. We're going to face some higher taxes and higher regulations, and I think that kind of cocktail of opposing forces, I think, are going to make markets more challenged. But I think the economy from here continues to get better. I am very pleased to see how we've got a vaccine, we've got a reopening, and this health crisis that I had mentioned. That our perspective on what this is hopefully going to fade at some point, and we can get back to business as usual.
And that's what I ask you about. Interest rates are rising, as you pointed out. We've got the 10-year creeping up past 1.1%, 10-month highs now. For traditional 60-40 portfolio investors thinking, what do I do on the fixed income side when you got treasuries? How much farther can we go? What would you suggest? Where should they put their investments in credit right now?
Well, we are seeing a lot of professional investors, large pension funds, endowments move into our area, which is alternative credit. I've been very, very involved in really establishing the bank loan market and the securitization part of that, called the collateralized loan obligation market, or CLO market. And that was kind of my claim to fame early on. And those markets are less touched by the Fed. The Fed isn't buying bank loans. It's not buying CLOs. These are floating rate markets. And so we're taking credit risk, we're taking volatility risk, but we're not taking interest rate risk, which I think is a very important point. I think the theme that I would tell investors to think about as they think about their fixed income allocation is take credit risk right now, not interest rate risk, because we've kind of reflated everything, and now we're very sensitive to rate risk. But as the economy gets better, credit, especially dual investment grade, can be the classic value trade. Right? You're handicapping whether companies can pay back their debt. And as the economy gets better, as we have this reopening and stimulus, even though rates may rise, you can find some very nice recovery trades and good returns there. And so I think I would tell them, focus a little bit more on credit risk. Go down in that credit quality spectrum, but don't take interest rate risk, because that's really that's going to hurt you.
Then don't have to go for investment grade. Maybe go for a little bit more risk on that towards high yield. And what instruments in particular?
Yeah, well, it is a difficult call, I think, for the general investor, because markets have reflated so hard. I mean, everything is priced to perfection, including high yield, including a lot of the markets that we trade in. For as an example, I mean, our team here is looking at the fundamentals across about $2 trillion worth of loans and bonds. And out of that whole universe, we see a little less than 10% of it as attractive to us. Now, we have 30 years of experience, and we have a very deep team, and we can parse through 1,200 different issuers and 10 times that, the number of securities that we look at. But, and you go through that, there's some very, very attractive returns. But for the general investor, they're not going to be able to do that, quite frankly. So it's a time of caution, but I would look for ways to get out of very high grade exposure that's going to have that sort of interest duration sensitivity, and look for other areas of the market that may be floating rate, that may be below investment grade, such as the bank loan market and the CLO market.
Okay, CLOs, bank loans, take a look at that. Thanks a lot, Mark, for your tips.
Sure.
Our thanks to Mark Okada of Sycamore Tree Capital Partners in Dallas. I'm Fred Katayama in New York. This is Reuters.